Imagine waking up tomorrow morning, right? And you find out that every single thing you buy is just permanently frozen in price.
Oh, wow.
Yeah, think about it. Your groceries, your rent, your mortgage, your investments, even like the subscription for your streaming service or that cup of coffee you grab on the way to the office.
Right.
None of it will ever increase in price again. We are talking about an environment of absolute permanent zero inflation.
I mean, to the average consumer, to you listening right now, that scenario probably sounds like an absolute utopia.
Oh, for sure. Because if inflation is the great economic villain we hear about on the news every single night, the force that eats away at your paycheck, then zero inflation must be the hero of the story.
It sounds like the ultimate financial relief.
It really does.
And, the human brain naturally craves that kind of predictability, especially when we are talking about survival and resource allocation.
Right, just knowing what things will cost.
Yeah. If you know that a gallon of milk is going to cost $3.50 a decade from now, and your rent will never budge, you can plan your life with, perfect mathematical certainty.
Which would be amazing.
You know exactly how much to save, exactly how far your dollar goes. It just feels safe.
But here is the massive paradox we are unpacking today for this deep dive. The most powerful financial institution in the United States, the Federal Reserve, looks at that utopian scenario of zero inflation and actively, deliberately works to prevent it from ever happening.
They really do.
They do not want your prices to stay flat. They actively want your hard-earned dollar to lose purchasing power every single year.
Specifically, they target an average annual inflation rate of 2%.
Right. And they do this under the official banner of supporting price stability and maximum employment, which is wild.
Which on the surface sounds entirely contradictory.
Totally.
I mean, we are taught from a very young age that our money losing its value is a negative outcome. A dollar that buys less tomorrow than it does today feels like a punishment.
Because it is a punishment.
Well, yet the architects of the modern American monetary system have decided that a slow, controlled, systemic erosion of your purchasing power is actually the foundational bedrock of a stable, functioning economy.
And so that is our mission today. We're going to interrogate this paradox from every possible angle. Why does the central bank intentionally want to devalue your money?
Yeah.
Where did this hyper-specific 2% number even come from? Was it handed down on a stone tablet?
Spoiler alert, it wasn't.
Right. And most importantly, when the economy is engineered from the top down to operate this way, who are the actual winners and who is quietly losing out?
Because when you really look at the raw mechanics of the system, it profoundly changes how you view your basic checking account, your student loans, your mortgage, and even your salary.
It changes everything. So to understand the Federal Reserve's underlying logic here, we first have to, redefine the enemy.
Yeah, when people hear the word inflation, they immediately picture an end state of punishment.
Right, they just see a painfully high price at the gas pump or, an outrageous total at the grocery checkout.
But in macroeconomic terms, inflation is not simply a state of high prices. It is a measurement of velocity.
Velocity?
Yeah, it is the rate at which prices rise across the broad economy over time. It's about speed.
Wait, I have to stop you there and push back on behalf of anyone trying to balance a budget right now.
Sure.
You are telling me the Fed wants my life to continuously get more expensive.
Yeah.
Because if inflation is 2%, a grocery bill that costs $100 today is going to cost $102 next year.
That is the math, yes.
And then even more the year after that. When you compound that over 10 or 20 years, it just looks like a guaranteed, systematic financial loss for everyday people trying to survive.
It is a gradual loss of purchasing power for a static, uninvested dollar, yeah? But the Federal Reserve is not sitting in a boardroom in Washington trying to figure out how to make the middle class poorer.
This feels like it sometimes.
I know it does. But they are operating from a place of deep institutional historical trauma. Their objective is to prevent scenarios that economists consider vastly more dangerous than a 2% annual price increase.
Okay, what could be more dangerous?
They are terrified of the extremes on either side of the spectrum.
So like the engine running too hot or the engine completely freezing over.
Precisely.
Let's talk about the engine running too hot first, because I think that context is crucial for understanding their fear.
Right, so look at the 1970s in the United States.
Okay.
For much of modern history before that point, the U.S. did not actually have an explicit publicly broadcasted numerical inflation target. Central banking was a bit more opaque back then.
Right.
And in the 70s, inflation became arguably the single biggest domestic crisis in the country.
Because it just got completely out of control.
Yeah, you had this brutal combination of massive oil supply shocks from geopolitical conflicts, monetary policy that was incredibly loose, and a spiral of rising wages all colliding at once.
Just a perfect storm.
It was. Inflation did not just rise, it broke into double digits, peaking well over 10% and staying elevated for years.
And the psychological damage of that era is still, like, burned into the minds of people who lived through it. Families literally watched their life savings evaporate in real time.
Yeah.
And businesses completely lost the ability to plan for the future. Like, if you run a construction company in 1978, how do you bid on a massive project that takes 3 years to build when you have zero idea what your lumber or steel costs will be 3 months down the line?
You can't. You really can't. The economy becomes paralyzed by uncertainty.
Wow.
And to break that fever, to finally kill that runaway inflation, the Federal Reserve, led by Paul Volcker at the time, eventually had to push interest rates to extraordinary punitive levels.
How high are we talking?
We're talking about the federal funds rate approaching 20%.
20%. That is insane.
It is, and it caused immense, devastating economic pain, bankruptcies, and a severe recession just to reset the system.
So the cure was almost as bad as the disease.
Right. The lesson central bankers took from the 1970s was undeniable. High, volatile inflation destroys the basic functioning of an economy. It destroys the core trust required for trade and investment.
Okay, so high inflation is a nightmare. Everyone agrees on that. It destroys purchasing power rapidly.
Yeah.
But if high inflation is the ultimate evil, I return to my original utopian scenario. Why can't we aim for things to just get cheaper? Why can't we have prices fall by 2% a year?
Yeah.
It feels like the natural healing cure to the inflation disease would be a heavy dose of deflation.
The terror of deflation is the other extreme, and in many ways, modern central bankers fear deflation even more than they fear a spike in inflation.
Wait, really? More than the 70s?
Oh, definitely. We have historical precedents for this, too.
Yeah.
Most notably, the catastrophic aftermath of the Great Depression in the United States in the 1930s.
Okay.
And more recently, Japan's lost decades of economic stagnation starting in the 1990s. Falling prices sound like a gift to a consumer in the short term, but continuously falling prices create a phenomenon known as the deflationary spiral.
Okay, think about it this way. Let's apply this to a real-world scenario to see why things getting cheaper is actually a curse.
Do it.
Let's say I am on a dealership lot today looking at a brand new $30,000 truck.
Right.
In our current inflationary environment, I might buy it today because I assume the manufacturer is going to hike the sticker price to $31,000 next year.
Yeah, you want to lock in that price.
But imagine I live in your deflationary world. Everyone in the country expects prices to fall by 3% every single year.
The psychology completely flips.
Entirely. I look at that $30,000 truck, and I realize that if I just go home and wait 12 months, that exact same truck is going to cost $29,100.
Right.
Waiting literally pays me $900. I am rewarded for doing nothing.
And it does not stop with you on the car lot. That logic applies to every major sector of the economy. Refrigerators, new homes, commercial real estate, factory equipment.
Everyone just waits.
Yeah. Millions of consumers and business executives run that exact same calculation. They realize that holding on to their cash makes them wealthier in real terms because their unspent cash will have more buying power tomorrow than it does today.
So what happens? They universally delay their purchases.
And the ripple effect of that delay is where the nightmare begins.
Because if millions of people stop buying trucks, the auto dealerships across the country start bleeding cash.
Yeah, they have lots full of inventory they cannot move, and they are paying interest on that inventory.
So the dealerships halt all new orders from the manufacturers in Detroit.
Which forces the manufacturers to immediately cut production.
Right.
They are suddenly selling a fraction of what they projected, so their revenue plummets. To survive, they have to slash their largest expense, labor. They lay off assembly line workers, marketing teams, logistics coordinators, and for the workers they do manage to keep, they lower wages.
And now those thousands of workers who just lost their jobs or took a massive pay cut have even less money to spend in their local communities.
Exactly. I mean, yeah, spot on. So they stop going to restaurants, they cancel their vacations, they stop buying new clothes.
Which forces those restaurants and retail stores to cut their own prices, fire their own workers, and halt their own investments.
The disease jumps from sector to sector. It feeds on itself in a continuous downward loop.
So the entire economy completely freezes.
Completely. Cash is hoarded, investment into research and development stops, and escaping that psychological trap is brutally difficult for a central bank. Once consumers are conditioned to wait for lower prices, it takes a massive, monumental shock to get them spending again. This is the deflationary spiral.
So this paints a very stark picture of the Federal Reserve's underlying philosophy. They are essentially navigating a massive ship through a narrow strait between two giant icebergs.
That is a great way to visualize it.
On one side, you have the runaway inflation of the 1970s, eroding purchasing power, destroying savings, and creating chaos.
Right.
On the other side, you have the deflationary freeze of the Great Depression, destroying production, incentivizing hoarding, and wiping out jobs.
The Federal Reserve's entire operational framework is built on avoiding those two extremes. They believe they need a buffer zone.
A middle ground.
Yeah, a narrow middle ground that provides enough price stability that businesses and families can make long-term financial plans while simultaneously ensuring that prices rise just enough to encourage people to invest and consume today rather than hoarding their cash under a mattress for tomorrow.
Which brings us to the most perplexing part of this entire framework, the specific number they chose for that buffer zone. 2%.
Yeah, the famous 2%.
Why exactly 2%? Why not 1%? Why not 3.5%?
It is a good question.
If you ask the average person on the street, they probably assume there is some incredibly dense, Nobel Prize-winning mathematical formula locked in a vault at the Federal Reserve that proves 2% is the fundamental gravitational constant of the economic universe.
The reality is much more surprising and, frankly, a bit more human. There is no absolute mathematical formula that generated the 2% target.
No way. Really?
Really, it was not a grand scientific breakthrough on a chalkboard. The 2% number evolved gradually through decades of real-world central banking trial and error. It is much more of a pragmatic discovery than a mathematical certainty.
The history here is fascinating because the United States didn't even invent this target. We have to look globally, back to the late 1980s and early 1990s to see where this really took hold.
Yeah, so in the late 1980s, New Zealand was wrestling with high and incredibly volatile inflation. The Reserve Bank of New Zealand became a global pioneer.
New Zealand, who would have thought?
I know, right? In 1989, they passed legislation that essentially mandated the bank focus squarely on price stability. And shortly after, they adopted an explicit, publicized inflation target of roughly 2%.
Wow.
They were essentially testing a radical macroeconomic hypothesis in real time. It was a massive experiment.
And the whole world was watching.
Yeah. Shortly after, countries like Canada and the United Kingdom observed this and followed suit, setting their own explicit targets near that 2% mark.
And the global economic community just sat back and watched to see if these economies would implode or stabilize.
And what economists observed in those countries over the following decade was highly encouraging. Those economies began to experience relatively stable, predictable growth.
Right.
They maintained low unemployment, and crucially, their inflation expectations became highly anchored.
Meaning people trusted the system.
Yeah, the public and the financial markets started to trust that prices would rise slowly and steadily, and that institutional trust created a very stable environment for corporate investment.
But the U.S. Federal Reserve didn't just immediately copy them. The Federal Open Market Committee, the FOMC, the group of officials who actually set interest rates in the U.S., debated this internally for nearly 2 decades.
Decades.
You read the transcripts from the 90s, and they spent years arguing behind closed doors about whether setting a hard public target would tie their hands too much or if 2% was even the right number to aim for.
It was a massive philosophical shift for the institution. For a long time, particularly under Chairman Alan Greenspan, the Fed preferred a strategy of constructive ambiguity.
Constructive ambiguity.
Yeah.
That sounds like a fancy way of saying, basically, we know what we're doing, but we aren't going to tell you the exact formula.
That is pretty much it. The logic was that by not telling the market exactly what their numerical goal was, they maintained maximum flexibility to respond to crises without being accused of missing a stated target.
Which makes sense politically.
It does. But the evidence from places like New Zealand and Canada became overwhelming. Finally, in January 2012, under the leadership of Chairman Ben Bernanke, the Federal Reserve formally and publicly adopted the explicit 2% target.
2012, that wasn't even that long ago.
Not at all. It was the culmination of 20 years of rigorous debate, not a sudden calculation.
So they finally picked their target in 2012. 2% it is. But that immediately leads to an incredibly obvious mechanical problem. How do they even know if they're hitting it?
Ah, the measurement issue.
Yeah, measuring the price of every single transaction in an economy as massive and complex as the United States seems literally impossible.
Because it is impossible to measure every transaction. You can't track every haircut, every used car sale, and every contractor's invoice.
Right.
Inflation has to be estimated using massive, continuous surveys of consumer spending and price checking. You are essentially taking a highly engineered sample of the economy to understand the whole.
But the specific tool the Federal Reserve uses to measure this is highly intentional and often misunderstood, right?
Mhm.
Most people who watch the evening news are familiar with the CPI, the Consumer Price Index.
Right, everyone knows CPI.
But the Fed primarily watches a different, broader metric, the Personal Consumption Expenditures Price Index, or PCE.
Yeah.
So why the preference for PCE over CPI? I mean, to the layperson, measuring inflation sounds like it should just be sending someone to the store to check the price of a basket of goods every month. Milk went up 10 cents, bread went up 5 cents, there's your inflation rate.
The primary reason the Fed prefers PCE is because it adjusts much more dynamically for changing consumer behavior. The CPI is based on a relatively fixed basket of goods. It assumes you buy the same things in the same quantities year after year.
Okay.
If the price of beef skyrockets because of a supply chain issue, the CPI assumes you are still buying the exact same amount of beef, so your measured personal inflation spikes dramatically.
But that is not how humans actually shop. If I go to the grocery store and beef is suddenly twice as expensive, I am not going to stubbornly buy it and bankrupt myself. I'm going to buy chicken or pork instead.
That behavior right there is what economists call the substitution effect.
Substitution effect.
Yeah. The PCE captures that dynamic shift. It accounts for the fact that when relative prices change, consumers shift their buying habits to avoid the most severe price hikes.
Makes a lot of sense.
And because of this dynamic adjustment, and because it includes broader spending categories like comprehensive healthcare costs paid by employers on your behalf, the PCE is considered a more accurate reflection of actual ground-level household spending pressures.
Even with this incredibly sophisticated PCE metric, though, measuring a modern, globalized economy is messy. The data is never perfect.
Never.
You are relying on surveys and massive statistical models.
Yes.
And this measurement problem is actually another massive reason why the target is 2% and not 0, right?
Economists are the first to acknowledge that inflation cannot be measured with absolute surgical precision. There is always a margin of statistical error in these massive indices.
Right.
If your true goal is 0% inflation, and you aim your monetary policies at hitting exactly 0, you have absolutely 0 room for error. If your measurement is off by just 1 or 2%, or if a sudden, unexpected shock hits the global economy, you could accidentally plunge the entire country into actual deflation.
It is a safety margin. The 2% target acts as a statistical buffer. You aim slightly above 0 so that if your math is wrong or if the economy stumbles unexpectedly, you land at positive 1% instead of negative 1%.
Yeah, you avoid the deflationary spiral entirely by giving yourself a cushion.
The statistical cushion is vital, but there is an even deeper, more structural reason for the 2% target, and it has to do with the labor market.
This is huge.
It has to do with how you get paid. This is perhaps one of the most counterintuitive and least understood justifications for the Fed's policy, and it dives straight into the psychological reality of wages.
This is the part that I think will frustrate a lot of people listening because it challenges the Fed's logic on a deeply human level. We are talking about the argument that inflation actually helps everyday workers.
Which, on its face, sounds completely absurd.
It relies on a concept economists call wage rigidity. To understand it, we have to look at the massive psychological difference between nominal pay cuts and real pay cuts.
Okay, lay it out for us.
Let's create a scenario. Imagine a mid-sized manufacturing company is going through a severe financial downturn. Their orders are down, revenues are shrinking, and they need to cut their total labor costs by 5% just to survive the year without going bankrupt.
Okay, pretty common scenario.
In a zero inflation world, the only way that company can reduce labor costs is to physically lower the dollar amount they pay their employees.
They have to pull a worker into the office, sit them down, and say, your salary is dropping from $100,000 to $95,000.
Yeah, that is a nominal pay cut. The actual number on the check is getting smaller.
And human beings absolutely despise nominal pay cuts.
They really do. If an employer tries to reduce the actual number on your paycheck, the workforce will likely revolt. Morale will collapse overnight.
Oh, for sure. The best employees will immediately quit and look for another job.
Right, because people view their nominal wage as a direct reflection of their professional value and their status. Reducing it feels like an intense violation of the psychological contract between employer and employee.
So what happens?
Wages are what economists call rigid downward. They almost never fall voluntarily.
So because the employer knows they cannot easily cut wages by 5% without destroying their workforce and causing a mutiny, they're forced to take a much more drastic, blunt force step to save money.
Yes.
They just fire 5% of the staff. Mass layoffs become the only viable pressure valve for a struggling business in a zero-inflation environment.
Now, run that exact same scenario in an economy with 2% annual inflation.
Okay.
The company is struggling, but instead of cutting your salary to $95,000 and risking a revolt, they just keep your salary perfectly flat at $100,000. They freeze your pay for the year.
Your paycheck looks identical. The number deposited into your bank account hasn't changed.
Right.
But because inflation is running at 2% across the economy, the purchasing power of that $100,000 quietly declines by roughly 2% over the year.
You have just taken a 2% real pay cut. Your labor cost to the employer has effectively decreased in real terms, helping them survive the downturn.
Wow.
But because it happens silently, through the ambient inflation in the economy rather than a visible, direct reduction in your paycheck, you are far less likely to quit, revolt, or feel personally insulted.
Wait, so the Fed's actual strategy relies on deceiving the American worker?
It's a stealth pay cut. They are relying on the fact that we look at the nominal number on our paycheck and ignore the rising cost of our grocery bills. That feels like systemic gaslighting.
It is uncomfortable to frame it that way.
The system expects workers not to calculate their real purchasing power on a daily basis.
And critics certainly use the term money illusion to describe this phenomenon, but macroeconomic policymakers argue that the collective benefit is undeniable.
What's the benefit? Just saving companies money?
No, it's about jobs.
Uh-huh.
By allowing this silent erosion, a small amount of inflation gives businesses the flexibility to adjust their real labor costs downward during difficult economic periods without having to resort to immediate catastrophic mass layoffs.
Oh, I see.
Historically, this dynamic has significantly reduced the severity of unemployment spikes during recessions. It keeps people employed who otherwise would have been fired in a rigid, zero-inflation environment.
So it is trading the invisible, creeping pain of a slight purchasing power drop for the highly visible, catastrophic pain of losing your job entirely and having zero income. Yeah, that is the trade-off.
That makes logical sense from a bird's-eye view, even if it feels deeply manipulative on the ground. But wages are only half of the structural argument here.
Right.
We have to talk about the relationship between inflation and interest rates, because this introduces one of the most critical mechanical concepts in central banking, the zero lower bound.
The zero lower bound is perhaps the most mechanical, mathematical reason central banks demand positive inflation.
Break that down for us.
When an economy enters a recession, the Federal Reserve's primary tool for fixing it is to lower interest rates. By making it cheaper to borrow money, they encourage businesses to take out loans to build factories, expand operations, and hire people.
And they encourage consumers to take out mortgages to buy houses and auto loans to buy cars.
Yeah. This influx of borrowed money stimulates economic growth and pulls the country out of the recession.
But there is a floor to how low those interest rates can go.
Yeah.
You can't just cut rates to negative 50%.
There is a very hard, very dangerous floor. Nominal interest rates cannot easily fall below 0%.
Why not?
If a central bank tries to push rates deeply negative, meaning a bank actually charges you a penalty fee just to keep your cash in a savings account, it creates massive, unpredictable distortions in the entire financial system.
Because if my bank tells me they're going to charge me 2% a year just to hold my money, I'm not going to leave it there.
What would you do?
I am going to march down to the branch, pull out my entire life savings in physical $100 bills, buy a heavy steel safe for my basement, and store it myself. My physical cash doesn't have a negative yield.
And if millions of people do what you just described, it completely breaks the banking sector. Capital flees the financial system.
Have we ever seen that happen?
We actually saw European central banks and the Bank of Japan experiment with mildly negative interest rates in recent years, and it caused immense stress on bank profitability and lending mechanics. This floor is the zero lower bound. It is a boundary you do not want to cross.
So how does a 2% inflation target interact with that floor? Why does 2% save us from hitting zero?
There is a direct historical relationship between the normal baseline rate of inflation and the normal level of interest rates.
Okay.
If an economy normally operates with 0% inflation, nominal interest rates during healthy growing times are also going to be very low, maybe sitting at just 1 or 2%.
Because lenders don't need to charge borrowers massive interest premiums to protect themselves from inflation eroding their returns over the life of the loan.
Correct. But if normal, everyday interest rates are sitting at 1% and a severe recession suddenly hits, the Federal Reserve only has 1 percentage point of room to cut rates before they hit zero.
They tap the brakes, they hit the floor almost immediately, and the economic car is still crashing.
Yeah, they are completely out of conventional tools.
But by artificially maintaining inflation at 2% during good times, normal interest rates naturally sit higher, maybe at 3, 4, or 5%.
Which means when the inevitable crisis arrives, the Federal Reserve has 4 or 5 percentage points of room to aggressively cut rates.
They have ammunition.
Exactly. I mean, yeah, they have firepower. The 2% inflation target essentially exists to stockpile monetary policy ammunition before the next recession arrives. It ensures the central bank has enough firepower to drastically lower borrowing costs and rescue the economy when things go inevitably wrong.
When you lay out the mechanics like this, the safety margin against the deflationary spiral, the stealth flexibility for corporate wages, the stockpiling of ammunition for interest rate cuts, it paints a picture of a very deliberately engineered machine.
It is highly engineered.
But machines have output.
Yeah.
And that output affects different groups of people in drastically different ways. If 2% inflation is the constant, inescapable backdrop of the American economy, we need to identify who is bleeding and who is thriving in this system.
The distributional consequences of monetary policy are profound, and they are rarely discussed openly by central bankers. The most obvious, undeniable losers in an inflationary system, even a mild 2% system, are savers holding idle cash.
The person stuffing physical $100 bills into a mattress or leaving their life savings in a basic legacy checking account, yielding 0.01% interest.
Anyone holding cash is mathematically guaranteed to lose purchasing power over time unless that money is earning an interest rate that exceeds the rate of inflation.
So cash is just a bad bet.
Cash, in a 2% inflation regime, is a guaranteed losing asset. It is a melting ice cube. If you hold cash for 30 years, its ability to buy goods is cut in half. The system actively punishes you for simply holding on to the base currency it issues.
Which feels fundamentally unjust to a lot of people. The instinct to save cash, to be frugal, to keep your money safe and accessible is viewed as a virtue in almost every culture on Earth.
It is taught as a virtue, yeah.
Yet the macroeconomic system actively penalizes it.
Yeah.
It slowly drains your wealth. But if cash savers are the losers taking the hit, who are the winners on the other side of the trade?
Borrowers are the most direct beneficiaries of inflation.
Really? How so?
If you take out a loan with a fixed interest rate, the actual value of the dollars you use to pay back that debt shrinks over time. You borrowed expensive, highly valuable dollars today, and you are paying the bank back years later with cheaper, inflated, less valuable dollars.
This makes anyone with a long-term fixed-rate mortgage one of the biggest winners in the American economy.
Oh, complete.
If you are listening to this right now in a house with a 3% fixed 30-year mortgage you locked in during 2021, you are pulling off one of the greatest financial heists in history against your bank, and the Fed's inflation target is helping you do it.
Mortgages are the classic, most impactful example for the middle class. If you lock in a fixed monthly payment for 30 years and inflation drives up the price of goods, and presumably over time drives up your nominal wages to match, that monthly mortgage payment becomes a smaller and smaller percentage of your total income.
The inflation is actively eating away the real economic burden of your debt.
Yeah, it shrinks the burden.
And it isn't just everyday homeowners playing this game. The biggest borrower in the world is doing the exact same thing on a trillion-dollar scale.
Yes. Governments are massive beneficiaries of inflation. The United States has an enormous national debt.
Right.
Because inflation gradually reduces the real purchasing power of the dollar, it also reduces the real economic burden of existing public debt. The government is collecting taxes in inflated dollars and using them to pay back old bonds issued years ago.
It is like a slow, silent default.
That is a very accurate way to put it.
Beyond borrowers and governments, there is one other major group of winners here, right? Long-term investors.
Those who hold productive assets. We are talking about stocks, commercial real estate, or direct ownership in businesses.
Why do they win?
Historically, over decades, the value of productive assets and the revenues of strong companies have outpaced inflation. Because businesses can eventually raise the prices of their goods and services to match inflation, their revenues grow, and their stock prices tend to reflect that nominal growth.
Looking at this list of winners and losers highlights a severe structural inequality built into the system.
It does.
The 2% inflation target essentially forces everyday people into the financial markets. You cannot simply earn a wage, save your surplus cash in a safe place, and build wealth.
No, you can't.
The system mandates that you must become an investor, taking on market risk, or a borrower, taking on debt risk, or just to tread water. It punishes the financially conservative, the people who just want to save their wages, and it richly rewards the leveraged.
That is a very valid, incredibly potent critique of the structural reality. And it is one of the primary reasons why the 2% target is not universally beloved, even among economic experts.
Wait, really? The experts disagree on this?
Oh, heavily.
Yeah.
The policy has fierce critics, and over the last few years, the debate over whether this specific framework is actually optimal has intensified significantly within academia.
Let's get into those counter-arguments, because holding on to this 2% number like a religious artifact seems dangerous. We aren't in the 1990s anymore. We have trillion-dollar deficits, rapid technological disruption, and global supply chain wars. Doesn't aiming for a rigid 2% force the Fed to occasionally break the economy just to hit an outdated target?
Some would say yes.
What are the critics arguing for instead?
There's a growing chorus of modern economists arguing that the underlying math and structure of the global economy has changed fundamentally since New Zealand pioneered this in the 90s, and therefore the target should change too.
Change to what?
A prominent counterargument from some very respected voices is that central banks should actually raise the target to 3% or even 4%.
What is the justification for deliberately running the economy hotter? If 2% hurts cash savers, 4% would absolutely crush them.
Proponents of a higher target point to structural shifts. First, we have massive, unprecedented levels of government debt, and as we just discussed, higher inflation helps manage that debt burden more aggressively.
Okay, that helps the government.
Second, we are seeing rapid, disruptive changes in global productivity, green energy transitions, and deglobalization. But the biggest argument goes back to the ammunition concept.
The interest rate cuts.
Yeah. A 3 or 4% target would provide even more of that crucial room for interest rate cuts during severe crises. If normal rates are at 6% instead of 4%, the Fed has massive, overwhelming firepower to fight a severe depression without ever worrying about hitting the zero lower bound.
But the critics aren't just arguing about moving the number up or down a percentage point. Some are pointing out massive blind spots in the Fed's entire philosophy over the last 2 decades.
They argue that by obsessing over this one narrow metric, this 2% consumer inflation target, the Fed has ignored catastrophic collateral damage caused by their policies.
What kind of collateral damage?
The primary critique here is that the Federal Reserve became far too rigid and narrow in its focus. For years following the 2008 financial crisis, consumer inflation remained stubbornly low. So the Fed kept interest rates near zero for nearly a decade to try and push that sluggish inflation back up to their 2% target. Critics argue that by keeping money that cheap for that long, they fueled massive destabilizing asset bubbles.
We saw housing affordability absolutely collapse for the average wage earner during that period. Stock markets roared to record highs, private equity boomed, real estate prices skyrocketed. But everyday consumer inflation on the CPI read 1.5%.
Yeah. The critics say the Fed was looking at a thermometer that read 2% and concluded the patient was perfectly healthy while completely ignoring that the patient's arm was falling off in the housing market.
It is the inherent danger of targeting a single aggregate index to judge the health of a complex system. But despite these very valid critiques about asset bubbles, and despite the very real ongoing debate about whether 3% might be better than 2% in a modern context, there's a fundamental consensus that anchors the economic establishment.
There is.
After all this disagreement, what did they actually agree on?
Inside economic circles, there is no universal agreement that 2% is a flawless, magical number. But the overwhelming consensus is that having a clear, highly credible, publicly stated target is vastly superior to having no target at all.
So the number itself isn't the magic part.
No, the macroeconomic stability does not necessarily come from the number 2 itself. The stability comes from the market's deep-seated belief in the target.
This synthesizes a massive realization about what the central bank is actually doing.
Hmm.
The Fed isn't just a mechanic turning dials on a money machine, adjusting the supply of dollars to tweak the price of goods.
Not at all.
They're engaged in a massive, ongoing psychological operation. They're trying to mind control the market.
Economics is ultimately the study of human behavior. Central banking is heavily reliant on managing mass psychology. Economists use a specific crucial term for this: anchored inflation expectations.
Break down how an anchor works in this context. Give me a real-world negotiation.
Let's say you are a union leader negotiating a new 3-year contract for thousands of factory workers. If you truly, deeply believe that the Federal Reserve will successfully keep inflation at 2% over the long term, you will act accordingly today.
Right.
You might demand a 3 or 4% annual raise for your workers. You want to beat inflation, but your demand is reasonable because your expectation of the future is anchored.
And the corporate executives sitting across the table from me, also believing inflation will be 2%, agree to that reasonable wage increase because they can model it.
Yeah, they can plan for it.
Furthermore, that company only raises the prices of its own manufactured goods by 2 or 3% because they don't expect their future raw material costs to explode. Banks lend money to that company at predictable rates because they aren't terrified of the currency collapsing.
The collective belief in the target literally creates the stability. It is a self-fulfilling prophecy of calm. Because everyone expects 2%, everyone acts in a way that generates 2%.
That is wild.
It is. But the dark side of that psychology is what happens when the anchor snaps.
If the public loses faith in the 2% target, if expectations become unanchored, the entire system unravels violently, right? If people suddenly believe inflation is going to surge to 8% and stay there, behavior changes instantly before prices have even actually risen.
Instantly. The union leader doesn't ask for a 3% raise anymore. They demand a 10% raise immediately, with cost of living adjustments to protect their workers from the impending crisis.
And the company, terrified that their steel and logistics costs are going to double next month, preemptively hikes the price of their goods by 15% today just to build a cash buffer. Lenders jack up interest rates on business loans to protect their capital from being paid back in worthless currency.
The expectation itself creates the inflation. Because everyone is panicking about future price hikes, they take aggressive defensive actions that instantly drive up current prices. The fear becomes the reality.
This psychological tightrope is exactly why Federal Reserve press conferences are treated as major market-moving global events. If you watch financial news, they treat a speech by the Fed chair like a sovereign declaration of war. It seems absurd from the outside.
It seems absurd, but central bank communication, often called forward guidance, is now viewed by economists as a policy tool that is arguably just as important as actual mechanical interest rate hikes.
Financial networks will literally analyze every single syllable of an FOMC statement. They debate whether the Fed chairman used the word elevated versus transitory. They analyze the tone of his voice. It is all about defending that psychological anchor.
Credibility is their most valuable asset. The market scrutinizes every word because if the Fed loses its credibility, if investors stop believing the central bank has the willpower to return inflation to 2%, borrowing costs across the entire global economy can skyrocket without the Fed ever touching a single button on their control panel.
The market just reacts on its own.
Yeah, the bond market will price in the panic on its own, and the Fed will lose control.
We don't even have to look back to the 1970s to see this theory put to the ultimate stress test. We just lived through it.
We did.
The COVID-19 pandemic provided a real-time global laboratory for testing the absolute limits of the Fed's framework. Let's bring this macroeconomic theory into recent reality. How did this 2% architecture actually hold up when the world shut down?
It was an absolute roller coaster that tested every single mechanism we have discussed today. Let's walk through the timeline.
Okay, take us back to early 2020.
In early 2020, the global economy effectively shut down overnight. The immediate fear among central bankers was a catastrophic deflationary collapse. Businesses were closed, no one was spending money, cash was being hoarded.
So the Fed used the ammunition they had been stockpiling.
Aggressively, they slashed their benchmark interest rate down to near zero almost instantly.
Right to the floor.
But they knew that wouldn't be enough to stop the freeze, so they also initiated massive quantitative easing. They injected extraordinary amounts of liquidity into the financial markets, digitally creating reserves to buy bonds and mortgage-backed securities, ensuring the banking system didn't seize up.
Did it work?
From a sheer crisis management perspective, the initial strategy succeeded. It stabilized credit markets and, combined with massive fiscal stimulus from Congress, prevented a systemic employment collapse.
But every action has a reaction. That massive rescue effort collided with a completely unprecedented real-world situation. We had a central bank injecting trillions in liquidity and Congress sending direct stimulus checks colliding with broken global supply chains and massive labor shortages.
The backlash was severe. You had too much money chasing too few goods, ships couldn't unload at ports, factories in Asia were shut down, and consumers were sitting at home with stimulus checks wanting to buy durable goods.
And inflation, which had been sluggishly sitting below 2% for years, suddenly caught fire. It soared month after month. By June of 2022, U.S. inflation peaked above 9% on the CPI. It was a 4-decade high.
The psychological anchor was being violently tested.
This forced the Federal Reserve into a massive, violent correction. And here is the profound irony of the COVID era. The exact same institution that pumped the economy full of liquidity to save it from a deflationary freeze in 2020 had to turn around and aggressively slam on the brakes to choke off the very demand they helped create.
They had to hike interest rates at the fastest pace in modern history. They went from 0 to over 5% in a little over a year.
That is just whiplash.
Yeah, they deliberately tried to slow down the economy, make borrowing painful, crash the housing market's momentum, and cool off the labor market, all to wrestle that 9% beast back down toward their beloved 2% target.
And despite years of elevated inflation, despite the severe economic pain those rapid rate hikes caused to borrowing costs and regional banks, the Fed's communication remained absolutely unyielding.
They refused to budge on the target.
They didn't come out and say, well, things are crazy right now, supply chains are permanently altered, let's just accept 4% as the new normal.
Because doing so would have destroyed their credibility. If they moved the goalposts the moment things got difficult, the anchor would snap.
Right.
Recent Federal Reserve statements aggressively emphasize that the 2% objective remains entirely unchanged. They are fighting a war to maintain their credibility, proving to the market that they will inflict whatever pain is necessary, even triggering a recession if needed, to keep long-term inflation expectations anchored at 2%.
Which brings us to the ultimate conclusion of this deep dive. When you synthesize all of this, the history of New Zealand, the mechanics of the zero lower bound, the stealth pay cuts, the psychology of the 2022 rate hikes, you realize that the Federal Reserve operates with a completely different dictionary than the average person on the street.
The redefinition of terms is the crux of the matter. In the eyes of the Federal Reserve, the phrase price stability does not mean zero inflation.
A world where prices never move at all is viewed as brittle, dangerous, and highly prone to catastrophic deflationary failure.
True price stability, in their framework, means low, stable, and predictable inflation. A world where prices rise by exactly 2% a year is deemed safer, more resilient, and more flexible than a world of frozen prices.
The 2% target is a tightrope walk. It is not a guarantee of wealth or prosperity for the average citizen. It is a defensive strategy.
Yeah, it is an attempt to keep the world's largest economy balanced between two equally destructive forces: the runaway, wealth-destroying fire of high inflation on one side, and the paralyzing, job-destroying ice of deflation on the other.
It provides flexibility for corporate wages to adjust downward silently, it preserves monetary ammunition for the next crisis, and it prevents the destructive psychology of hoarding cash.
It is a systemic compromise.
But it is a compromise that relies entirely on faith, which leaves us with a massive, unresolved question to ponder as we wrap up. We have built this entire economic engine on the premise of anchored expectations, on a shared psychological belief in a somewhat arbitrary 2% target designed decades ago. But what happens if the audience stops clapping? What happens if a new generation of workers, a generation shaped entirely by the post-pandemic chaos, by wildly unaffordable housing where prices outpace CPI by magnitudes, and by the persistent feeling that their wages can never actually catch up to their real costs? What happens if they simply stop believing that the central bank can or will control the narrative? If the anchor of the global economy is only made of trust, what happens when that trust is permanently gone?